Hi, I'm Keith McCullough, and welcome to the Hedgeye Investing Summit. This is one of my favorite times of the year because I get to spend a lot of time learning from very accomplished and competent people. Again, we like to think that the people that we invite are not only people that you're going to learn from, but again, people that are actually doing things in the marketplace that are producing results. And there's no better example than that to lead off today with Diego Parrilla, who runs Quadriga. And Diego, first of all, you get to go first because I think you have the best performance out of anybody who's going to speak at the Hedgeye Investing Summit. I challenge anybody who's going to be on next to tell me a number that's better than up 35% net for 2020. Obviously, 2020 has not been an easy year to navigate, but it's not your first rodeo. No matter what analogy I use, soccer, rodeos, or whatever. I mean, you're up 10% in 2008 as well, or a couple years ago. It was
18, yeah.
Yeah, 2018, sorry, 2008.
2018, yeah.
So, I mean, you're proving something that a lot of people have a hard time proving. And maybe start with that. Like you had a lot of fans associated with how you explained your process using a soccer analogy last time. But having a defense and a goalie, I mean, this has to be where it started, is it not? This year for you to be up that much, and you were up that much before, or actually during a period where a lot of people struggled.
Yeah, I think perhaps one of the most important concepts, and thank you for having me, by the way, it's an honor, is to understand the rules of the game. And I think a lot of people think, going to the soccer analogy, that investing is about making money. And I would argue that this is a game where, first and foremost, if you want to win, you must not lose. So it's a game of capital preservation. And then it's about compounding on that capital preservation. If you cannot preserve your capital, then compounding doesn't matter. So based on this, I think there are maybe three pieces that I would use. The first one is the fact that a portfolio is a team. Okay, this is not just about stars and people think, well, Messi is the best football player in the world, best soccer player. If I could only have a team with 11 Lionel Messis, it would be great. Well, it doesn't quite work like that. You need effectively the team where you will have offense, defense, midfielders. So this idea of team is critical. The second point I would make is that precisely on that idea of team, you need your individual players, people like me, managers or strategies, to do what they're meant to do. You want the offense, the strikers, to score goals. You want the goalkeepers to do saves. You want the midfield to keep the ball and pass it around. I think in that sense, when you fail to do that, you end up with a very dangerous thing called false diversification. You end up building a team with 11 strikers or 11 goalkeepers, and that doesn't really work. And the third key thing is this is not about having a crystal ball. It's not about being smarter or whatever. This is about doing what you meant to do and have a team that is balanced. And understanding that these cycles you need to navigate. And therefore, the idea of rebalancing the portfolio is the key third message I would give, is the market will go crazy sometimes. You'll have, the S&P at all-time highs, or close to at the moment for whatever reason. This might be the time perhaps to rebalance that team and perhaps take off some of those strikers and add goalkeepers. And there are times when the opposite happens. You have absolute panic. The strikers are on sale. You could have the S&P at whatever 2,200, and you want to be rebalancing that portfolio. What you want to do with that is you want to embrace the volatility of the market. You don't want to fight the volatility of the market. You want to embrace the volatility. You want to embrace the irrationality or stupidity. You want to make money while you sleep. And no better way of doing that you build your team, you pick your players, and you rebalance them on a very systematic basis. And I think that's the key, rather than pretending I'm the best, I know it all, I have a crystal ball, and I just double and triple up on positions.
Well, for a long time, I mean, that's what Wall Street painted, hedge fund managers to be. Like they had some divine intervention where they came up with a certain amount of ideas or strikers that were going to make a lot of people a lot of money, in a very concentrated portfolio. Or some people today, they think that it's just about Bitcoin. Therefore, they just buy and hold one position, and there's risk management despite drawdowns. But when you explain that, first of all, that's awesome. Secondly, you sound like an American football coach by the name of Bill Belichick, who, point number two specifically, like in my vernacular, is do your job. Like the players in your portfolio have to do their job. And the third one I think a lot of hedge funds struggle with is that they have, like a lot of people actually don't even know how to do the job. So the PM gets in a tough spot because he's trying to be a good leader and implementing their ideas, but there's no asymmetry to the portfolio. So on that last point, which is, I think Bill Belichick would prefer a game that's laden with uncertainty because that's where he can manipulate and evolve. Is that why you do well with volatility? You seemingly do better with volatility, and you embrace the uncertainty of it all.
Look, as a goalkeeper, you have to. One of my sayings is, "You're as good as your last crisis," and I think Wall Street tends to be very short term in the basis that everybody talks as you're as good as your last trade. I don't agree with that. I think you have to be, as a goalkeeper, you have to be ready, just like a fireman. You're not improvising, and being a contrarian is actually pretty core. I mean, you do spend a lot of time with dynamics that might be against you, very what I would define as artificial markets. And this is where the framework of the anti-bubble comes in, and is quite powerful, I think. And here the idea is, let's think first about what a bubble is. Okay, mm-hmm. and bubble, I love to borrow George Soros' definition. He looks at bubbles as assets that are artificially expensive, based on a belief that happens to be false. Okay, so basically, the emperor had no clothes, and this situation. What I did as an engineer in my second book was to generalize the framework and say, well, fair enough. Misconceptions can distort reality, but not only through artificially high valuations, which we call bubbles. You could have also things that are artificially cheap, which I call anti-bubble. And this is powerful because, first of all, recognizes the fact that bubbles and anti-bubbles emerge from beliefs and misconceptions. Mm-hmm. So you're looking at assets that are grossly artificially cheap that will revalue as a matter of when, not if. The second dynamic is that by identifying those misconceptions, you have assets that by construction will implode and refloat or whatever at exactly the same time and catalyst by construction because they are exactly the same process. They're like two mirror images of the same misconception. And the third thing, going back to being a contrarian, there's an element of risk premia in this, which is ideally you're actually getting paid by taking the other side of the market. And let me give you a clear example, which is, I would argue that the relationship between equity valuations like the S&P and the VIX. Okay, the last two big moves that you mentioned, 2018 and Q1 2020, actually came from the VIX around 10. Mm-hmm. It's not a coincidence. Okay, it's not a coincidence. You have a volatility being artificially low, based on both qualitative and quantitative drivers. Qualitatively, we're looking at the complacency of the markets, the idea that mommy and daddy, central banks and governments are going to come and rescue us. Quantitatively, things like trend followers that are max long at the top on artificial low vols. And what this does is effectively, it creates a lot of hidden leverage. Value at risk is artificially low. It's based on both implied and realized volatility. And it's what I would argue, if you're driving your car at 200 miles an hour and the speedometer says 80, okay? If you had an accident, boom, what do you feel? And the answer is simple. You're going to feel whatever speed you were running, whatever risk you were running, regardless of what the speedometer was saying. So I think in that sense, being a contrarian, understanding these processes and trying to hopefully build up a portfolio of assets that are artificially cheap will allow you to perform that asymmetric role and that performance when the team needs it the most, okay? Which is effectively when those bubbles collapse. So, I think, as I said, you need to navigate the cycle, you need to protect the capital, but I think it's important to perform as a goalkeeper during these hostile markets, and that's what we humbly try to do.
Now, when you have a bubble that is coming unwound, I mean, clearly the definition of a bubble popping is when the volatility of that asset is high and rising and stays high. That's how I try to teach people to think about it. You're in the wrong regime of volatility. In many cases, think of your example, the VIX. Being north of 30 on the VIX is episodic and non-trending, as somebody who's oriented like a little bit more like how Mandelbrot taught me how to think about it. What do you think about that? Like in Q4 of 2018, let's use two examples where you navigated it beautifully. Q4 of 2018, for everybody who didn't run money back then, most people got absolutely hammered in the fourth quarter by Quad 4 and a volatility breakout above 30 on the VIX, Diego, as you know, but it didn't really stay there. I think it was there for Christmas Eve and maybe a day before that. So that was episodic and non-trending, whereas the vol complex that we see now, particularly in the NASDAQ, is well above 30 and it stays there.
Yeah, I think you need to think about volatility. I like to think about it as an engineer. I use the analogy of fluid mechanics, okay? Nature, okay? There are really two regimes in nature. The laminar regime and turbulent regime. And there are periods of time when relationships are predictable, they're linear, and the world behaves in a given way. Volatility and correlation, when the market goes turbulent, and I would agree with you that 30 is a good level when things move or shift from perhaps more laminar to turbulent. It also depends a lot from where we were coming from, what level you were coming from. If you run up from 10 to 30, it's not the same as 25 to 30 where we might be now.
Yep.
But I think the important thing to understand is that when we moved into a turbulent regime, then fundamentals don't matter, hell breaks loose, and it's 100% about effectively forced liquidation and people who thought they were running again in their car, they're driving comfortably at 200 miles an hour without fully acknowledging the real danger they were running. And then this starts a very simple mechanical process. It's mechanical, okay? Mm-hmm. As volatility goes up and you realize you're running a lot more risk, or the market's taking you out. If you're a day trader, it will be a minute trader, not a day trader in that regime. You have to cut the size of your positions. As you cut the size of your positions and everybody has the same position, this creates, effectively, it feeds on itself. So what happens is you go from artificially low volatility and artificially low correlations to a level where volatility starts to increase and correlations start to increase. And the compounded effect of higher volatility and higher correlation effectively leads to all the models crumbling. I mean, we saw even risk parity, right? One of the incredibly robust models that did well throughout periods blow up in a way or suffer significant forced liquidation through Q1 this year. So in that sense, I agree with you that volatility is a key driver. We are now in a regime where the market is in some ways licking its wounds from being short volatility. We need to understand that the relationship also comes from high realized volatility leading to higher implieds, and there's more complex. And so I would argue that this is partially contributing to having less leverage in the system right now, and why in some ways the market might be holding better. But I think this is hugely important. We look at it very closely. And again, there are those times when the market is overly complacent, when volatilities and insurance is artificially cheap, and you want to accumulate on this insurance because eventually this is something that will handsomely pay out. Now, you need to be creative about insurance. And when you think about just plain vanilla VIX or S&P puts, it's not easy. I mean, some of these things have very deep negative carry, and there's a lot of big challenge, for goalkeepers like ourselves to buy insurance and survive those long periods. So the challenge is, how do we manage this? And this is where perhaps adding correlation and other pieces makes your insurance slightly more refined, but even potentially more explosive during things when things blow up. And this is something that, again, there's a lot of science in this. It's not just plain gold up or S&P down. You're looking at many pieces that include volatility, or even scenarios that the market may not see, like gold higher and S&P lower, or S&P lower and dollar higher. And so I think a lot of the challenge, a big challenge here is how do I find the cheapest insurance possible that will be the most explosive when I need it, and I do it with the best possible carry, and that's the challenge.
Well, I think that's basically the hidden gem in what you do. You're reallocating your bets constantly to the better probability. After the high probability event that people thought was going to happen doesn't happen. So I mean, there's a positioning side to that as well. How much attention do you pay to the market's positioning, whether it be, I mean, you trade options as actively as anybody that at least is going to be in this investing summit. So how do you think about that in terms of the street's positioning, non-commercial CFTC futures and options positioning, for example?
Well, positioning is very important. It will drive the market for long periods of time, and particularly during times of stress. And it's responsible for many of these very abrupt moves we're looking at. The ideal scenario, when you can't ignore positioning, just like you can't ignore technicals. But we are, if you think about building asymmetry, this is not, as I mentioned earlier, a game, in my view, of conviction. It's not necessarily about, I know I'm right, 90% of the time I'm right. This is incredibly dangerous because people who are playing on high conviction are, they may win a certain percentage, but when they lose huge. And it's very difficult to calibrate. How often you're right is hard to calibrate. So to me, it's all about asymmetry of payout. Okay, it's much easier when you buy an option for 10 cents on the dollar, and it will either pay 0 or 100. That's it. That's you have to get right 1 in 10 to break even, and it's a lot easier to calibrate asymmetry of payout than asymmetry of conviction. So what are the stars that you want to align? I mean, sometimes, and this is rare, but it happens. And there are times when you have a very high conviction. You do your numbers, 2 + 2 = 4. And the market says it's 16, and you're like, well, I think it's 4. So you're highly convicted, but you know that 2 + 2, the market can say it's 32. So you're cautious about that. You find a very efficient way to get those odds, in a very asymmetric way. So you tick the box of conviction, you tick the box of asymmetry, and ideally, it's a non-consensus play. Yep. That's when you really hit the jackpot in a big way. And the challenge is when, let's take gold, for example, you might be correct long-term, but the positioning might be a little bit overextended and you're fighting one of those legs. So these pullbacks might be very healthy in the long term, but they're pretty difficult to navigate. So I think when you think about this, all the pieces of asymmetry, whether it's fundamental analysis or good entry exit through technicals, or positioning, being a contrarian, or others, we are going always to focus on asymmetry of payoff first and foremost, and we will look at many others as a way to effectively increase the size or adjust the timing. But I would say this is a game of asymmetry, and you want to have as many sources of asymmetry as possible, and you want them to compound the odds in your favor.
When I think about that, I mean, I think of all my mistakes, obviously, and what I used to do. What I used to do when I started using options was that I'd pick a price that I thought I had high conviction of being right. That's different than the asymmetric payout. Now you use call spreads, put spreads, you spread your bets, and change your bet when your first bet was wrong. Like, this isn't unlike a blackjack table where you get the next hand. You don't have to sit there with the former hand. And that's something that it took me, I swear, Diego, it may have taken me the last half decade, and I've been doing it for 2 decades to figure that out. Hopefully that it didn't take you that long, but is that a fair way to think about a mistake that a lot of people new at this using options might think about the game?
Yeah, I think look, there are infinite ways of making and losing money. So I can tell you that in my humble opinion, this is a search to what works for you. And I think that has to do with your own personality. And in my particular case, I'm very comfortable spending premium, okay? And I can sleep at night because I know I can lose $1 million in this position, but I know I cannot lose more than $1 million, and I have a year to be correct. I cannot sleep at night if I have a $1 million at risk, and I could be taken out by a sharp move in the market, and I'm stopped out, And with the gap risk, I ended up losing 3 million. That really takes my sleep away, but some people are very comfortable. So from that point, some of my lessons learned, I think everybody who starts trading options starts selling options. And they say, oh, this is so easy. Yeah, someone's paying me 10 cents for this thing that will obviously never happen. And I think this is where, you have to live to tell. Okay, and once you, it's just a matter of time that those things happen for one reason or another. So I had my scars, and I learned that lesson. And I learned I couldn't sleep, and I didn't enjoy it at all. And I flipped sides very comfortably. And in fact, the risk management, the obsession with, as a goalkeeper, you have to stay in the game. And I think this goes to some of the spirit of what we do. I mean, we have a strategy that, despite the large numbers, uses no linear leverage. Okay, we don't lever on the core long positions. We don't use any outright shorts, like a long short. Okay, because this creates, I mean, as a commodity guy, I've seen things like Brent WTI, that looked like they moved like this, blowing up. And, people would trade 100 lots of flat price that is directional. And then when they traded the spreads, they say, well, this moves less than, I trade 100 lots of WTI, but Brent WTI moves very little. I'll do 1,000 lots. And I used to say, look, your risk here is way large. I mean, what's your risk? And people would say, well, it's not a lot because, look, it doesn't move. It's like, well, if you want to be conservative, you should really think like you're long 1,000 lots and short 1,000 lots. And it's like, wait, that will never happen. And it's like, well, things do happen. And precisely those moments when the correlation breaks and goes to -1 and everybody has the same position, things explode in your face. And the third way to get this hidden leverage is by using short options. And I hear this all the time. People saying, and I use Tesla for the lack of a better example, right? Look, Tesla is a terrible asset. I'm going to buy puts, and I'm going to finance them by selling calls. And the point I always make is you're not financing anything. Your long puts, your short calls, this thing just went up 400, 800%, and you just blow up. And so I think in that sense, it's important to understand with an options mindset, again, what fits your profile. But I think options are extraordinarily conservative as long as you know how you're using them and as long as you buy them. The minute you start being funky by effectively selling stuff and trying to fund and get stuff, these things can blow in your face. So my humble advice would be, start by buying options. Be very, very careful with selling them, no matter how appealing it might look. There will be times to do that, but always with risk very controlled, because these things do happen. So, we are in a way the other guys. There's people that are constantly selling this stuff. We're the other guys. The challenge is, how do we buy these options the cheapest possible, most explosive possible, with the best carry? And as I said earlier, it's not an easy task.
Yeah, I like that a lot. I mean, you're keeping it simpler than most people. People try to, and I think that's a problem. I've seen it at multiple buy-side shops where the options guys come in to help you. And all of a sudden I feel like I'm at the zoo. It's like condors and butterflies. I'm like, oh shit. This is like, I'm confused. All I want to do is express my bet in a more efficient way, is the way that I've thought about it. So I think that this concept of asymmetry of payout is fantastic versus asymmetry of conviction, which for a long time people on Wall Street have had to show their conviction as opposed to the payout. And I think that's obviously changing with performance. I guess just to use one example on this, because I think you and I have a somewhat similar view on gold in particular. A lot of upside on a different duration and shorter term due to, at least I saw, coming into this week in particular, some downside on immediate term dollar correlation. And again, it has nothing to do with my fundamental thoughts on gold. It has everything to do with the payouts. And I wonder how you would tell people to construct a longer-term gold position. I think you've said that you think it's got $1,000 or $2,000 of upside longer term, but that's very different than what could happen to you today.
Absolutely, I think that's the reason why when I published that article in the front page of the Financial Times called "Gold's Perfect Storm," a few years ago, gold was 1,200, and I was calling for 3,000 to 5,000 gold within 3 to 5 years. And it did sound like science fiction, And people might come to me and say, hey, Diego, I'm going to sell my house and buy gold futures and go levered. I would be like, dude, you're going to go bankrupt. I mean, it's not about being correct. You have to survive the run. This is the reason why I said you can't be levered on a linear basis, because the market will take you out. So I think when you think about gold, you can have, and we do have, core positions that are non-levered that hopefully will see the day and that will make money. But a lot of the asymmetry comes from these options components. But for most people who are listening or watching, even options might be a little bit hard to implement. And even if they have access to vanilla options, it's really not easy. I mean, you might be, I don't know the number exactly off the top of my head, but we're looking at, if you wanted to buy a 3-year gold call, that might cost you 17, 18, 20% of premium. I mean, that's a heck of a lot of money. I mean, first of all, you need to pay 20%. Second, even if gold, went up by call it 50%, you're barely making, 2.5, 3 times your money, which may not be sufficient. And if you're early or wrong, you could lose all that money, so you have negative carry. So even a vanilla option, which it's nice, it's conservative, it gives you some leverage, has this break even. Gold needs to go up by 20% for you to start making some money. So even then, it's not easy. Now, things that we've done and we continue to do is, we're looking for that contrarian side. And I love, in particular, taking 2 views that we believe in or that are fit our mandate, and combine them into one. So I can give you several examples, but one of them would be a negative view on China. Okay, we have a negative view on China, medium, long term, and we think the currency, the yuan, is the degree of freedom in the system. So as China continues to do the same thing of printing and borrowing their way out, the yuan is a degree of freedom. So we might have a view that the yuan might devalue significantly over the medium term. And we also have, which means the dollar appreciates versus the yuan. And then we have another view, which is gold effectively appreciates in dollar. Now, when you think about the correlation of the market sees it as you're either long or short dollars. So by taking the view that, we think you might see gold significantly higher and the yuan significantly lower, the combined probability based on not only individual distributions and probabilities, but also the correlation between them, means that scenarios of gold much higher and the yuan much weaker are extremely unlikely according to the mathematical models. And so you can actually buy stuff that, it's in order to pay out, you need a couple of things to happen, but it gives you enormous discounts to the vanilla version. I'm talking about 70, 80, 90% discount to the option. So you're no longer paying 20%, you're paying things that are way cheaper. And you could do this, and we are, in fact, we did another of these today, where if you bet on S&P below current levels, so 3550, and gold some sort of 9-10% higher from here in the next year, you make pretty much 9 to 10 times your money. So $1 million, you could lose $1 million, or you could make 10. This comes because you're combining probabilities. You are effectively taking 2 views. In our case, they're both core. I mean, as a goalkeeper, we want to make big returns when equities collapse, if they ever do. And then you obviously want to combine that with a view where that collapse will come with way lower interest rates and much more of the same, and that will lead to effectively much higher gold. So what I'm trying to come up with here is it's not easy to play this. Avoid the leverage because it can take you out in the short term. Think long term. And when you think about the ways in which you can do this, we need to be able to find that asymmetry. And if it's not there in the vanilla options, then in our side, we will try to do things that, unfortunately, they're not. You need to have special relationships and contracts to be able to transact this insurance. It's not like you can just buy it anywhere off the shelf. But this is part of the reason why I think it does make sense to outsource sometimes some of the functions. You could be an expert in a doctor and be very good at COVID and biotech, but perhaps there's other areas where you want to delegate. And I think we are finding that some of the largest institutional clients in the world are delegating to us, and we feel very honored and humbled to play that role for them, because this is what we focus on, and that's it. We want to be that left tail guy.
It's typical of people that are transacting, like I'm a fan of Nancy Davis, who runs the ETF as iVol, and she's trading the volatility of the curve, like interest rate curve, and tips in particular. And it's hard to execute her strategy if you're trying to do it on your own without institutional relationships. It's just a fact. So I think that's a really important point. Last question before we take your other people's questions. If you have questions throughout the Investing Summit, again, they'll get voted upon. I'll ask the questions that look like they have a lot of votes, and if I don't like the question, I probably won't ask it, because I'm a little biased. I will try to not antagonize people. Actually, not. But the reality is, we're not trying to antagonize people. We're trying to have a real conversation here. And one conversation that we haven't had yet is on the thematic side. So you did mention something that I would qualify as what you think could happen longer term, which to me that's what I call a macro theme. You may or may not be right. In the short term, the market's voting on whether or not the probabilities of that are going up or down. So my themes, as many people know, have a central tendency to change because the numbers change. But on the theme that you have, which I'm quite interested in, because it's one that I think is a much higher probability as well, but you can't see it immediately, is I think you said it's going from bubbles to economic stagflation. How do you do that?
Well, look, let me give you just a quick view of the last 10 years and what I think the next 10 years. And I summarize the last 10 years in one sentence, which is the transformation of risk-free interest into interest-free risk. And this is critical to understand, because we need to know that 10 years ago, U.S. Treasuries or the German bonds were paying you something called risk-free interest, which it's called 5%. So you as an investor had the great benefit of saying, look, I don't want to take any risk. I'm going to invest my money. I'm going to earn 5% per year in nominal terms. Inflation is low. I'm earning some real return on my money. And then guess what? If there was a crisis and interest rates went to zero, your 10-year bond or treasury could make you 50% capital gains. Okay, so you not only had the ability to earn some risk-free money in real terms, you had a fantastic defender. Mm-hmm. Now, in a world where interest rates are zero or negative, this has changed. There's no longer a risk-free interest. And second, your conventional defenders and goalkeepers like the treasuries or the bonds have greatly diminished defending power. So that's why I call the bond Beckenbauer, based on that legendary footballer from the 70s, who was a great defender, but is now 74 years old. He has less defending power.
It matters.
But then you look into effectively the third implication, which is when you're discounting cash flows. I mean, when you think about artificially low interest rates, and you think about any cash flow asset that effectively works out its value from discounting things, if you had interest rates of 5%, the present value of a cash flow of $100 in 10 years was $62. 20 years was $38. And 30 years was about $22, $23. And 50 years was $8. Today, with zero negative interest rates all the way out, every single one of those cash flows is worth 100. So the bubble that we've built in any cash flow asset is phenomenal. In fact, this situation has led to a change in the rules of the game. And the big enemy today are the bubbles, which are basically too big to fail. Think about what would happen if we tried to normalize monetary policy. Every single bubble, every single one of these assets, equity, credit, high yield, the whole thing would implode, which takes us to a point where these bubbles are too big to fail, they're systemic. And what we're witnessing today is a paradigm shift whereby central banks are effectively trying by all costs, and governments, to prevent the bubbles from collapsing. And this is the situation that leads us to your question, which is what will happen in the next 10 years. And I summarize the next 10 years in one sentence, which is the transformation of bubbles too big to fail into stagflation. Because we have to remember one thing, we are not solving any problems by or trying to print and borrow our way out of the problem. By printing infinite amount of paper, by taking infinite debt, by giving money for free, we are not solving the problems. We are doing four things. We're delaying, so you're effectively giving debt and kicking the can, giving it to the next generation or whatever. Second of all, you are transferring this problem, and currency wars and its mirror image, trade wars, are driving and have been driving global markets for the past 10 years and are exacerbating. Today, it's all about the dollar up or down. Third, we are transforming these problems into inflation. And this is absolutely critical for portfolio positioning next year and into the next decade. And I think you're either going to be long or short inflation. It's as simple as that. So you have to avoid things like, if you want strikers, equities are better than credit. If you want midfielders, real assets and real estate are better than cash. And if you want goalkeepers, gold and anti-bubbles are better than fixed income. And the fourth issue, which is really bad news, is you're really enlarging the problem. So this combination of things is truly sad. And when I get to dedicate my book, I always say, I hope you like it. I hope I'm wrong. And I mean it because I feel like a doctor that is diagnosing a really terrible disease to a friend. You say, dude, as a friend, I want to be wrong. I want to be wrong. As a doctor, you want to be correct. But it's that situation where you're looking at what's happening today, and I think you and a few of us are looking at this situation with the mindset and the benefit of history and the lessons learned, and we're just going through these terrible issues. So I think the next decade is likely to accelerate into stagnation and stagflation, and this is just not a very pretty scenario. It's pretty much one of the worst we can look at, and it comes with consequences.
Yeah, it is. I'm saddened by it when I try to explain this to my mom, my dad. I'm from a blue collar, I guess you'd call it, family. I wouldn't characterize people as part of classes. We didn't think of life that way. But really, it's just a wealth transfer too. That's the big transfer, where the people that get it are going to be long of inflation, and the people that are going to pay the bill are unaware. So that's a real sad thing too. I think obviously that's found its way into the political zeitgeist of many countries, not the least of which this is not new for Europeans, but it's certainly accelerating rate of change terms here in the U.S. And it is sad. It's pathetic, in fact, that we have to sit here and actually make money on it at the same time. I actually have some, I don't want to feel anything about that actually, because I have to. If you want to change anything, you got to, like you said, stay in the game. So thank you for that, because I do think that if you think about stagflation, there's a historical lesson. And by the way, if you're right on gold, I mean, over the longer term, and the longer term outlook is stagflation. That's what a lot of people don't quite get that. I call it Quad 3, but in 2011, of course, when gold hit its prior all-time highs, we had 3 consecutive quarters, Q1, Q2, Q3 in 2011, of Quad 3 stagflation. And Bernanke devalued the dollar to a 40-year low, and commodities, in as much as gold, hit all-time highs. So it's not that hard for people to understand if they're students of history. And it's definitely not that hard for me to understand your theme there. Just because we have like 7 or 8 minutes here, Diego, I hope you don't mind. I'm going to just jump into these questions. Mitch from Chicago, I love it when most of our subscribers or viewers are giving us their real name and where they're from. We appreciate that. Diego, what role does cash play in your strategy?
Well, cash is not a big role, because cash is, if we go back to the soccer analogy, cash is a striker in the bench. So people tend to look at taking the money, putting it out of the game, and waiting, and waiting for the right opportunity to buy another striker. That's the way people think about cash. The problem with cash is what I would call the frog in the boiling water. Okay, we've been told that the target inflation is 2%. I mean, nobody believes that inflation is 2%. I mean, that might be the official CPI, but I'm not getting me started there. Real inflation is way higher. Yeah. But we're being told that that's what it is. And 2% is not a coincidence. Is a number that has been, I think, scientifically calculated to be you're all familiar with the frog in boiling water. You put a frog in boiling water, it jumps. You put a frog into mild water, and you basically heat it up, and the frog will die. It will never jump. That's what happened with inflation. You are in a phase one. You're being boiled with inflation at 2%. Look, 10 years. This is literally stolen over 20% plus compounding of your purchase power. After 20 odd years, you've already lost 50% of your purchase power. Okay, when you're my age, 20 years is not what it used to be, and it goes a lot faster. And you realize that this is what's being played. So in a scenario where inflation is accelerating, this is a bit of a problem for cash, but it's also a problem for credit, and it's also a problem for fixed income. It's a problem for anything that will give you a fixed cash flow at maturity, because whatever bond you like, AT&T bonds, Apple bonds, in 20 years, the $100 or €100 that you're going to get, they're not going to buy you much at all. And this is related to, I think, the three levels. If this was a video game, there are three levels in this game. The first one is, can you make money in nominal terms? It's already hard enough. Okay. The second is, can you make money in real terms? Can you beat inflation? This is the game where we are now. We're moving to level 2. And then the third one will be, can you make money in real terms after taxes? And that it's coming as well, and that makes the game even harder. So I think, I think in your to your question, I think cash is something that the central banks are really pinching us. Say, dude, you're totally stupid. Why would you leave your cash? And now it's negative interest rates, nominal rates. So they're not even pretending just with zero and real rates, which is a concept many people are not familiar. In Europe, we're being hit by outright negative interest rates. And this is part of the financial bullying in the system that is forcing us to go into taking more risk. And that makes this game so difficult.
The game is extremely difficult, and maybe that's a great point. Certainly one I hadn't thought of. When I ask you what your performance is, 35, I said, is that net? Now it's going to be, is that net and net of taxes? Because again, they're coming for you, because we understand, they understand. It's an interesting thing. I mean, this book, I'm not going to spend much time on it with you, but the deficit myth. I mean, it's all good in plain theory, but when you especially if you don't adjust for currency and taxes. But those are two pretty big things, and they're nonlinear in many cases. So that's an interesting one. Here's a good question. I get asked this question actually a fair amount, because people really like the idea of being better at options, but they're not always so clear in terms of timing. Jim from Cleveland, Ohio. How far out in terms of expiration dates do you go with your downside hedges, Diego? Do you have a certain budget in terms of percentage of portfolio?
Yeah, this is very important. We have a soft limit that seeks to spend in the region of 5 to 7% per annum.
Wow.
In premium. Okay. However, we are able to spend that over time. So our current spend, it's north of 20% in premium, which is options in 2020, 21, 22, 23. And we even have some options that go out 30 years. And this is because you want your options to protect you under multiple scenarios. So if you have a 1 week option, that's effectively pretty much a pure gamma play. It's really a directional move. If you have a long dated option, it's thinking of more about the vega of the portfolio, the uncertainty, and the standard deviation of the distribution. So they can be, I would argue that gamma is very good in the short term as a defender, but obviously your options are expiring and you need to renew. That makes it very painful. When you're thinking about this longer dated insurance, that can actually pay handsomely during periods of bigger stress like 2008. But you want your portfolio to be also diversified in terms of puts and calls. So I like to buy puts on bubbles and calls on anti-bubbles. So you buy puts on S&P, on credit, on high yield, on commodities. You buy calls on gold, on treasuries, on the VIX, on the dollar. And there's a lot of relative value here. The market is not always telling you the exact same picture. It could be paying a big premium for out of the money puts on the S&P, which makes them very expensive. But perhaps the other side of the tail on treasuries might be very cheap. So you want to find as much of a diverse portfolio as possible. I have about 75 options in the book at the moment, and this combines maturities, puts, calls, different underlines, different payoffs, and again, that goes to the idea that you want to be as diversified as possible, and even then, there could be scenarios such as this dollar up and down move that could challenge a lot of those positions. So I think that diversification and it's critical when you build these portfolios, and maturity. It's critical. Having budgets is important, being disciplined, and that means taking profits and reinvesting wisely.
Yep.
And that's something that you want to be as mechanical as possible.
Yeah, we call it, it's not soccer, but pruning and planting. So again, defining your budget is a real important thing, and diversifying those bets, but also turning those bets. I mean, you've explained this wonderfully. I wish I had like the rest of the Investing Summit to keep going through all the questions that people have for you, but we're running out of time here. So first, thank you very, very much for all of your knowledge and being so open and transparent about your process. Not everybody does that. And also, congratulations on having an awesome year. That this is going to go down as a big one for Diego, indeed.
It's been an absolute pleasure. I hope people found it helpful. If you want to reach out through Twitter or LinkedIn or whatever, very happy to continue that dialogue. And yeah, it's been an honor. Thank you so much, and enjoy the rest of the conference, which looks awesome. So I might be tuning in right after this.
Well, thank you. Yeah, I appreciate that. We'll be with actually with Raoul Pal next, which most people will be tuning in. Thanks for being with us here so far.